Imagine you're sitting at your kitchen table. Right. It's like 11 o'clock at night.
A very stressful time for your checking account to be hovering near zero.
Exactly. Your checking account is empty. Your car engine was literally smoking in the driveway an hour ago. And you need exactly $900 by tomorrow morning to keep your vehicle running.
And, well, by extension, to keep your job.
Right. So welcome to today's deep dive. We are looking at the actual mechanics of financial survival when you are, backed into a corner.
Because we're pulling from a very specific strategic guide today titled, I Need a $900 Loan Now, Understanding Your Options and Making an Informed Decision.
Okay, let's unpack this. Because this guide, it operates as a crucial survival manual for those sudden financial potholes we all inevitably hit.
Yeah, and it strips away all the abstract macroeconomic theory.
Right, we aren't talking about 30-year mortgage rate fluctuations today, or, like, geopolitical inflation.
No, not at all. We are looking at the brutal, fast-paced mechanics of short-term borrowing, how lending algorithms assess you in real time.
And the structural traps inherent in emergency credit. Our mission today is to explore the reality of this specific type of borrowing, including online resources like Enable Loans.
Because the core tension of the text really revolves around the dual nature of emergency capital.
Yeah, getting funds quickly solves an immediate burning problem today.
But the mechanics of how that capital is priced can easily, set fire to your financial foundation tomorrow.
Exactly. So before we look at the specific lending mechanisms, we need to examine the anatomy of the unexpected. Why $900?
Yeah, right. It's a very specific, awkward amount of capital.
It really is.
Right.
Like, why do people find themselves needing this exact amount? The source material catalogs some highly specific systemic disruptions.
Things like emergency vehicle repairs or unexpected medical deductibles.
Sudden utility shutoff notices. And what the text calls temporary cash flow gaps between paychecks.
Yeah, that $900 figure sits in a very particular, uncomfortable zone in the financial landscape.
How so?
Well, it's too large for the average person to casually float on a nearly maxed out credit card. But simultaneously, it's too small for a traditional Tier 1 bank to even care about.
Oh, right, because a massive commercial bank doesn't want to underwrite a tiny $900 loan.
Exactly. The administrative cost of the underwriting process itself completely wipes out any profit they might make from the interest.
Makes sense. I mean, I look at the $900 emergency like a blown tire on the highway.
Okay, I like that analogy.
Right. Like a blown tire isn't a completely total vehicle. It's not a $50,000 crisis.
But it instantly brings your entire life to a sudden, screeching halt.
Yes. Your commute, your ability to generate income. You are stranded on the shoulder of the highway until that highly specific component is replaced.
Yeah, it's a micro crisis with macro consequences.
But looking at the source's terminology, I actually take issue with the phrase temporary cash flow gap.
Really? Why is that?
Because when an individual is forced to take on high-interest debt just to bridge the days between today and their next paycheck, gap implies a small hurdle you just step over.
Right, a minor inconvenience.
Yeah, but mechanically, taking on a loan to survive the week operates a lot less like a gap and a lot more like walking off a cliff.
Well, what's fascinating here is how the source material actively addresses that exact panic. The authors use the term temporary gap to separate the event from chronic structural insolvency.
But the psychological danger is still there.
Absolutely. When you are standing on the edge of that cliff, panic dictates your behavior. That's why the text establishes a foundational rule of borrowing. Calculate your exact liability and borrow only what you mathematically need.
So if the mechanic quotes you $900, you finance exactly $900.
Precisely. Because the instinct, driven entirely by the stress of the cliff, is to seek a buffer.
Oh, like rounding up.
Right. The borrower thinks, if I need 900, I should request 1,200.
Yeah.
Just to have a cushion in the checking account.
Which sounds completely reasonable when you're terrified about money.
It does. But the text warns heavily against this because short-term lending is front-loaded with fees. Every extra dollar borrowed is subjected to origination fees and compounding interest.
Wow, so you're paying a premium just for that cushion.
Exactly. If you round up an extra $300, the mathematical reality of a high APR loan means you might be paying back $450 just for the privilege of letting that cushion sit idle in your bank account.
That is, wow. So the text is demanding extreme precision to limit the collateral damage of the interest rate.
Precision is the absolute baseline.
Okay, so precision is the baseline. Once you have isolated that $900 figure and resisted the urge to pad the request, the pressure shifts to actually sourcing the capital.
Right. Where do you go to get the money?
The source material maps out a specific borrower's menu of options, and a close reading reveals that the underlying financial mechanics of these options vary wildly.
They really do. The guide points to personal loans, installment loans, online lending platforms.
They specifically note Enable Loans as a digital resource to explore, right?
Yeah. And then they also list credit union loans and community assistance programs.
It's quite the spectrum.
The menu is essentially organized by accessibility and cost, which in the lending market are almost always inversely correlated.
Meaning the easier it is to get, the more it costs. These varying mechanisms actually remind me of trying to find a ride across a massive city.
Okay, how so?
Well, seeking a loan from a credit union is structurally like taking the city bus. It operates on a heavily regulated, completely transparent route.
Right. It's incredibly safe and cheap.
Exactly. But it moves slowly. It requires you to go to a specific location, and it might not run at 11 p.m. when your car actually breaks down.
And the online lenders.
Online lending platforms function like a rideshare app. They rely on massive digital infrastructure. They're accessible instantly from your phone, and the capital arrives fast.
But the algorithm prices inconvenience and risk, meaning you might get hit with the financial equivalent of surge pricing.
Surge pricing on a loan, that's terrifying.
Yeah, it is. But that algorithmic pricing is a vital distinction. Traditional banks and credit unions rely heavily on relationship banking and trailing indicators.
Like a traditional FICO score.
Right, to assess risk. Because their risk model is conservative, their interest rates remain low, but online platforms often utilize alternative data.
Like what? What are they looking at, if not just a credit score?
Well, they might use software to connect directly to your checking account. They analyze your cash flow, deposit frequency, and overdraft history in milliseconds.
That's incredibly invasive, but incredibly fast.
Yeah. They take on borrowers that traditional banks reject. But to offset the statistical likelihood of default across their entire portfolio, they have to charge a premium to the borrowers who actually do pay them back.
Which makes sense from a purely mathematical standpoint. But looking at this menu, one category genuinely stands out to me as structurally mismatched.
The community assistance programs.
Yeah. Why does a financial guide about borrowing categorize community assistance programs right alongside amortized banking loans?
I mean, they are completely different instruments.
Right. A utility relief grant or a local rental assistance program isn't a debt instrument. It doesn't sit on the liability side of your personal balance sheet. So why are they grouped together?
From an institutional finance perspective, you're right. One is a loan, the other is essentially a grant or equity injection.
So why list them together?
Because from the perspective of the individual in acute crisis, they both achieve the exact same utility. They neutralize the $900 threat.
Oh, I see.
The text places them side by side to force the borrower to evaluate the varying qualification barriers. Because the cost of capital on a grant is zero.
But the barrier to entry might be massive.
Precisely. It's the opposite of the online lender. A community assistance program might require extensive documentation of poverty, residency requirements, and weeks of bureaucratic processing.
So the cost isn't money. The cost is time and stringent eligibility.
Exactly. While the online platform requires very little time, but the cost is capital. The guide insists borrowers audit the entire menu rather than reflexively grabbing the fastest option.
Because realizing you qualify for a non-recourse grant fundamentally changes your financial trajectory compared to signing a high-interest installment contract.
It's night and day.
Okay, so once a borrower selects a lane from that menu, they trigger a mutual evaluation phase. The text makes it clear this is not a unilateral plea for money.
No, it's a highly structured, data-driven negotiation.
Right. The lender executes a risk assessment on the borrower, and the borrower must execute a structural assessment on the lender's terms. It's like a high-stakes first date.
Or an exchange of granular data for capital.
Yeah, like a corporate merger on a micro scale.
Yeah.
The lender performs their due diligence. The source lists their primary targets: income verification, employment status, banking history, credit score.
And state regulations.
Yes, and that is what I want to push back on. I was looking at that list, and state regulations stood out as bizarre given the context of a personal emergency.
Bizarre how?
If an individual needs capital to replace a transmission today, why on earth does the lending algorithm factor in the geographic borders of the state they happen to be parked in?
Oh, because consumer credit law in the U.S. is not a monolithic federal system.
Yeah.
It is a highly fragmented patchwork of state-level legislation.
So the rules change depending on where you're sitting.
Drastically. The mechanics of what a lender can legally charge you changes the moment you cross a state line.
Give me an example.
Well, many states have strict civil and criminal usury laws, capping the maximum allowable annual percentage rate, or APR, at roughly 36%.
Okay, 36% is high, but it's a cap.
Right. But other states have completely deregulated interest rate caps for short-term loans,
Ah.
allowing APRs to climb into the triple digits.
Wait, really? Triple digits? So a lending platform literally has to ping your IP address or verify your home address because the enforceability of the contract relies on local law.
Exactly. And that geographic reality dictates the lender's profitability.
So they might deny you just based on your zip code.
Yeah. A lender might look at a borrower's thin credit file and decide that the risk of default requires an 80% APR to make the math work.
But if that borrower lives in New York,
Where strict usury caps exist, the algorithm simply auto-rejects the application because the state makes the necessary risk pricing illegal.
wow. So geography acts as an invisible regulatory shield, but it also actively restricts access to capital.
It's a double-edged sword. And understanding that risk pricing leads directly to the most critical phrase in the borrower side of the evaluation.
The total repayment amount.
Yes. Most borrowers focus entirely on the monthly payment. They ask, can I afford $150 a month?
Which is how car dealerships sell cars.
Exactly. Lenders know this, and they structure the loans accordingly, often extending the term to make the monthly payment look palatable. But the total repayment amount is the actual metric of financial damage.
It combines the principal, the compounding interest over the life of the loan, and the upfront origination fees.
Yes, those origination fees are deadly.
Yeah. They operate like a cover charge just to enter the loan, right? Like if a lender charges a 10% origination fee on a $900 loan, they might simply deduct $90 from the disbursement.
Right, so you receive $810 in your checking account.
But you are paying compounding interest on the full $900 from day one. By the time an individual finishes a 6-month amortization schedule, that original $900 problem might have required $1,300 of real capital to solve.
Which is why the text demands that borrowers calculate that final aggregate number. You have to evaluate whether the engine repair is truly worth a $1,300 extraction from your future earnings.
Assuming the borrower calculates that number, accepts the terms, and is staring at the final signature page, the source outlines one last defensive barrier.
Yes, the strict internal audit.
You have to perform this before the funds are accepted and a legal contract is bound.
I like to call this a cognitive circuit breaker.
Yeah, the guide provides a specific set of self-audit questions. Do I really need to borrow it? Can I comfortably make the payments? What is the total cost of borrowing? Are there alternative solutions?
And they pair these with behavioral mandates.
Like reading all the terms carefully, understanding the specific dates on the schedule, avoiding taking multiple loans simultaneously.
And having a fully mapped repayment plan in place before accepting the capital.
Right. And I understand the theory here, but I have to challenge the practical application of these self-audit questions.
Okay, lay it on me.
If a borrower is staring at a severed transmission and risking termination from their job if they don't clock in tomorrow, hasn't the "do I really need to borrow this" ship completely sailed?
It certainly feels that way.
And furthermore, demanding that a borrower ensure they can comfortably make the payments seems detached from reality. They had comfortable cash flow, they wouldn't be attempting to borrow $900 at high interest in the first place.
This raises an important question regarding the psychology of scarcity. Your critique is entirely valid in a vacuum. The borrower is already in distress, so comfort is an illusion.
Exactly. It's survival, not comfort.
However, the text deploys these questions to force a micropivot in strategy.
A micro pivot.
Yeah, asking, do I really need this, isn't about questioning the broken transmission. It's about questioning the scope of the repair.
Oh, like a temporary fix.
Exactly. Can the mechanic apply a $200 patch that holds for 30 days, allowing the borrower to save capital for the permanent fix, rather than financing the entire $900 immediately? The audit attacks the tunnel vision created by the crisis.
I see. It slows down the reaction time so you don't overcommit future capital.
Yes. And your point regarding the impossibility of comfortable payments, that is exactly why the source provides the most critical warning in the entire document.
Avoiding multiple loans simultaneously.
Right. The mechanics of a debt spiral rely entirely on borrowers attempting to juggle impossible payments.
Because if the first loan extracts $150 from your account on the first of the month and you don't have it, You trigger a late fee.
And then what do you do?
You panic. Then you seek a second, separate $200 loan just to cover the first loan's payment and penalty.
And mechanically, taking a loan to service another loan is disastrous because you are compounding the principal and stacking origination fees.
You now have two separate entities extracting high-interest yields from the exact same stagnant income stream.
You are no longer borrowing capital to fix a mechanical pothole. You are actively financing the excavation of a deeper financial trench.
Which is the underlying logic behind the guide's insistence on using platforms like enableloans.online for research before the crisis hits.
Yes, mapping it out ahead of time.
The text explicitly states you must have a concrete repayment plan mapped out before the money hits your account. You have to look at your actual calendar.
Pinpoint the exact dates your paycheck clears.
Right, and mathematically prove to yourself how the capital will route from your employer to your checking account and back to the lender.
Because you cannot build an effective supply chain for repayment if you do not know the precise schedule, the hidden fees, and the daily accrual rate of the interest.
So the internal audit doesn't exist to shame the borrower for needing the money.
No, not at all. It exists to equip them with the operational data necessary to regain control of their balance sheet.
Pulling all of these mechanisms together, the core message of this deep dive becomes a blueprint for defensive finance.
Defensive finance, I like that.
If you find yourself vocalizing the phrase, "I need a $900 loan," now acknowledging the mathematical vulnerability of your position is step one.
And from there, it is about understanding the underlying architecture of your options.
Recognizing the structural difference between the heavily regulated city bus of a credit union
The algorithmic speed and risk pricing of an online platform.
and the non-debt reality of community assistance. That's the foundation of making an informed, mathematically sound decision.
A borrower must actively separate the emotional panic of the present from the mathematical reality of the future.
By comparing offers, dissecting the origination fees, and matching the aggregate life cycle cost of the loan to a proven future cash flow model.
You construct a firewall against the debt spiral.
Which leaves you, the listener, with a final strategic concept to evaluate. We spent a significant amount of time analyzing the mutual evaluation phase today.
How algorithms pull your existing credit history, analyze your banking inflows, and cross-reference your state's regulatory environment.
Right, all to determine your exact access to capital during a sudden crisis. Since your options tomorrow are entirely dictated by the structural health of your financial profile today, how might you proactively audit and optimize your data right now?
Essentially auditioning for emergency capital long before the $900 pothole actually strikes.
Exactly, because algorithms evaluate historical data.
You cannot build a 5-year credit history in 5 minutes. Preparing the balance sheet today ensures the capital is accessible tomorrow.
You have to build the structural safety net long before you are forced to walk the tightrope. Thank you for joining us on this deep dive into the hidden mechanics of short-term borrowing. Keep analyzing the structures around you, keep asking the hard questions about where the money flows, and always map the math behind the fine print. Until next time.